Well, thanks, Christy. And hello, everybody. I see some of you jumping on the call as we speak here. So welcome. Really appreciate you joining the call. Again, my name is John Thomas with Nationwide. I'm really excited to share with you a little bit about Nationwide and some of the long-term care solutions that we offer. You may have heard us bantering back and forth a little bit about technology as we're loading up this webinar. It's funny, I was at the long-term care, the National Long-Term Care Conference last week. Some of you may have been able to join out in Jacksonville, but one of the sessions I attended was about the future of elder care, and the future of elder care being robotic. Really intriguing. They used Japan as really a study in how elder care is going to change. And we really don't know what the future is, but Japan is kind of leading the way in new ways of elder care, and they have robotics really taking care of the elderly as we speak. There's a huge generation mismatch in that there are a lot of people retiring and elderly, a lot more than the younger generation can care for, which with the baby boom generation here in the United States, we have in our future as well. So there are companies like Mitsubishi and Panasonic developing these robots to care for people. So it's really amazing to see some of this technology that is coming to the U.S. soon. So I think we're really going to see a change in the market in the coming decade. So really interesting stuff. But part of what I'm going to be talking about today is informal caregiving. You may have seen in the invite that today is Informal Caregiving Awareness Day, and it's a part of elder care planning and a part of the elder care planning conversation that we're starting to become more aware of and really understanding not just financial solutions for retirement and that second phase of retirement where we need elder care, right? But also the family dynamic and what really reality is when it comes to caring for our loved ones as they age. So I want to talk a little bit about informal caregiving and really what it is and what what is existing in the market, but really where there's also an opportunity to help our clients better plan for this final stage of their retirement. But before I jump into that, just a little bit about Nationwide. I know that many of you probably know Nationwide as a brand. You probably have seen a few of our commercials. Maybe you know Peyton Manning's been our spokesman for a little while. Maybe you can sing the jingle, right? But you may not know that we are a mutual company. Being a mutual company is huge for us because it allows us to manage our company not for short-term stock market growth or market growth, but it allows us to manage our company for the long-term success of our policyholders. And as a mutual company, when someone purchases a Nationwide policy, they become a small owner of this mutual company. And so we're managing our company for the long-term success of our owners, of our policyholders, those that are policy owners in mutual with Nationwide. So that's a huge part of who we are. We've been around for 90-plus years. We're a Fortune 100 company, actually number 69 on the list as of last year, $26 billion in revenue. So we are strongly positioned to be here in the future. You see there about $5 billion in surplus. You can see our ratings here on the screen, and we've got a diversified portfolio. Now, I mentioned who Nationwide is and that we have strength and stability in our financials because it is important. Many of you I know are familiar with the long-term care market and long-term care carriers. You've seen long-term care carriers come in and out of the market over the last several decades. You've seen some of the changes in the long-term care insurance market as carriers, didn't predict claims experience accurately and unfortunately had to close their doors, right? So as we're having a conversation about companies to do business with, it's important to understand that you're going to do business with a company that's stable. To give you an example, in 2008, when we had the housing market bubble burst and the market fell, right, and companies were taking bailouts left and right, Nationwide had a surplus year. Believe it or not, we have a strong financial business. Our financial business alone is on the Fortune 500 list. But because we are so well diversified with a property and casualty business, with a financial business, commercial property, you name it, we have these diversified businesses that, even if our financial business takes a hit in the market, our property and casualty business may have a surplus year. Or in years where there are a lot of hurricanes, our property and casualty business takes a hit, our financial business carries us through those storms. And so you're doing business with a company nationwide that is well positioned to be here in the future to deliver on long-term care claims, which is huge when looking at long-term care solutions. So I really wanted to set the stage with that call and talk about who we are as a company and our value. And part of our value is delivering a long-term care solution that meets all needs, not just a set list of needs. And as we talk about informal care, really this idea that our perception of elder care in the insurance market and in the planning market has been a myth, right? When we look at long-term care planning, we often think of nursing home, we think of facility care, we think of home health care, right? There's a trend to, well, I shouldn't say a trend, but our awareness of how people receive care is expanding, and we understand that a majority of people prefer to stay at home as long as possible, right? And you see here on the screen that 2015, a total of $242 billion were spent on qualified caregiving. That's facility care, home health care, qualified nurse coming into the home, or nursing home, a total of $242 billion almost. But what about informal care, right? Informal care is care that is paid for informally. It's not a qualified nurse. Maybe it's a friend, maybe it's a neighbor, maybe it's one of the ladies at the church, right? It's not a qualified caregiver, but we're paying for care for an informal caregiver. It also includes family members, spouses that provide care, kids that provide care, right? And we know that this sort of informal care is where all care begins. Very rarely does someone start to need help with what we call activities of daily living and hire a paid caregiver. Often they have loved ones around them that help with this small amount of care in the beginning of this elder care scenario, right? Now, when we look at what the cost of that informal care is and compared to qualified caregiving, believe it or not, informal care in the same year accounted for about $522 billion. That's $522 billion. So we're talking almost double what was spent on qualified care was spent on informal care. And within this $522 billion, we're looking at what was spent on informal care, but also what was lost in economic power. And we'll talk about a little bit what we mean by lost in economic power. To put this number in perspective, Walmart is the #1 company on the Fortune 100 list, right? They have the highest gross revenue of any company, any domestic company in the U.S. Walmart did about $482 billion in revenue in 2016. So to give you a sense of the scope of what we're spending in informal caregiving, it outweighs what the largest company is doing in annual revenue. I mentioned that, the cost of informal caregiving is about double what's spent on formal health care, home health care, and facility care combined. So that really is staggering to think about what's being spent and the economic power that's being lost. Now, who's providing care? About 66% of folks that are receiving care at home receive all of their care exclusively from family. We typically see that as a wife, daughter, oftentimes eldest daughter, moves home to provide care for her parents. 26% receive some combination of family care and paid help. Only 9% of people currently receiving care are receiving paid help alone. So that just gives you perspective that there often is family or loved ones involved to some degree. It might not be all of the care. It might only be a portion. It might only be, help here and there and then managing the paid care, right? family and loved ones are involved in the caregiving situation. Now, three big issues facing caregivers: economics, time, health, right? And informal caregivers face a deficit in all three of these areas. So when we talk about economic power loss, we're talking about family members that quit their job, that reduce hours in their current work, that lose investment in their 401k, they lose investment in their own retirement because they're reducing their income to care for loved ones. So that is the individual economic loss. And a caregiver over their lifetime estimated to range from a total of about $284,000 for men to about $324,000 for women. So between the two, about $300,000 over your lifetime, the average individual may lose in economic power caring for their loved ones as they age. And so that often looks like reducing or quitting a job for a period of time to care for a parent or a loved one. So that is a significant loss on individuals and families as they care for loved ones. Loss of time, to give you perspective, about 30 billion hours per year are spent on informal caregiving. 22 billion of those hours performed by people with full-time jobs. So it's not just people quitting jobs. There's a big majority of those that are working full-time and then going to care for a loved one as soon as they get home, which puts an enormous amount of stress on people. To give you a sense of that, 17% of caregivers say their overall health is fair to poor versus 10% of the general population. And that number jumps to 22% of higher hour caregivers, which are those that provide care for 20 plus hours. More than, and that's more than 2 times the general population. So we have significant risk to our health by providing care. And to the degree that 40% of sole caregivers predecease the patient for whom they're caring. And that generally looks like spouses that are both elderly but providing care for one another. One spouse, needs help with their activities of living, bathing, eating, dressing, getting in and out of bed, in and out of the tub, those things, and they have an elderly spouse caring for them and helping with those things. That is significant physical and emotional stress that often leads to their passing before the spouse they're caring for. So really our message within this informal caregiving is that it needs to be a part of the conversation, right? As we're looking at long-term care solutions to plan for qualified caregiving, which often gets the focus of the conversation, right? How are we going to prepare for the expenses of a nursing home? How are we going to prepare for the expenses of assisted living or hiring a nurse to come to the house to care for us a few days a week? How can we also incorporate what is the best solution to care for the financial future and health of our kids, right? Do we want the burden to be on our kids to provide for our care, right? That needs to be part of the conversation, because the truth of the matter is, no matter what we think currently, once we get to that age and we're failing physically and we need some help, our loved ones will come and help us. Whether we put up a fuss or not, they're going to be there to help us, and that's been borne out through statistics, is that family does care for one another, right? We'd like to think that that's not going to happen, but it generally does. And so what is the most flexible solution to help address some of these costs and burden of informal care? So when we talk about nationwide, one of the primary solutions that we have to address long-term care is nationwide Care Matters. And why is it different from what's in the industry? Well, Care Matters is a linked benefit solution, or what's often called an asset-based solution. It's designed to be a guaranteed long-term care product built on a life insurance chassis. And it's built on a life insurance chassis to give it the benefit of guarantees. If you're familiar with traditional long-term care insurance, it's very much like auto insurance or homeowners insurance. You pay a monthly premium, you have a stated benefit for when you have a loss, and it reimburses you for your loss. In the case of care, if you're paying for qualified care, you have loss due to paying for qualified care, it reimburses you for that loss. but it is not guaranteed. And as companies saw major increases in the cost of health care and saw higher than anticipated claims, the premiums on those products increased dramatically. And so that really affected the market and affected consumers' willingness to buy long-term care insurance. Also with traditional long-term care insurance, if someone passed away having paid premium for, let's say, 15, 20 years, they didn't get anything for paying that premium. If they passed away after 20 years and never needed the long-term care benefit, then they didn't get anything for all those years of premium. And so those are some of the obstacles to using traditional long-term care to plan. Long-term care solutions built on life insurance, on the other hand, give us the benefit of a guaranteed premium that will never change, and also a death benefit should we never use it for long-term care. So it kind of addresses this concern of use it or lose it, right? If I don't ever get to use it for long-term care, I lose all of my benefit. Well, this addresses that concern, that we do get a death benefit that is really a return of premium paid. It's a cost recovery. Should we die, we're able to pass away or pass along a death benefit to our beneficiaries. And so it gives you some return no matter what the outcome. And so it's pretty beneficial in that way. Now, Nationwide's product is different in that it is a cash indemnity benefit. It is one of the few cash indemnity products. It's actually the only cash indemnity product in this category of long-term care solutions. Those are long-term care solutions based on life insurance. And as a cash indemnity benefit, you can think of it as a solution that pays you income to meet your long-term care need. And when you're getting income, you have the flexibility to use it however you like, right? You can pay for informal caregivers. You can reimburse or pay a family member that's quitting their job or taking time away from their job to care for you. You can expand your house. You can modify your house to be able to stay at home for as long as possible. So receiving income to meet your long-term care need is the absolute most flexible way to meet any long-term care or elder care need that a family decides upon. Different from solutions that are reimbursement-based, meaning that they will only reimburse a qualified caregiving expense, which is a nursing home, a facility, or a qualified in-home care nurse, right? And so getting an income solution really expands our opportunity to help folks plan around really what they decide as a family is best for them. A couple other things Nationwide offers, and you see there in the fourth bullet point, informal caregivers, exactly as I've said, this will pay you an income that you can hire informal caregivers or pay family and friends. We offer a 20% residual death benefit, which is guaranteed. This is really like an attached final expense policy that pays above and beyond the long-term care benefit, and I'll show you in detail how that pays out in a slide or two here. And then benefit banking. Benefit banking with Nationwide is a little bit different than with traditional long-term care solutions that talk about banking benefits inside the policy. Well, if you don't use all of your benefit, you don't get to it, you can bank benefits inside of a policy with a traditional plan. But the risk is if you pass away, all the benefits that you've banked inside that policy stay in the policy. You don't get that money. You don't get to pass it on to your beneficiaries. With Nationwide, any extra benefit that you collect as income, you can bank in an account with Nationwide, or you could bank it in your personal savings or checking account, in your brokerage account. You name it, you have any option, you can invest that money, but you're banking money in your own pocket. And so it is money that if you pass away, it's already in your own pocket. You can pass it along to your family and friends. A couple other notes on cash indemnity that are unique. Nationwide pays the owner of the policy versus reimbursing the insured for their expenses. And so you can come up with some unique designs. You can name a family member the owner of the policy, and they will get the income from those long-term care payments, and then they can use that income to manage the insured's care. This is also the only type of long-term care plan that can be placed inside of an irrevocable life insurance trust. And for wealthy individuals that have estate tax concerns, they can use this as an extra planning vehicle to create some tax arbitrage, which really creates some fantastic opportunity for wealthy individuals. We will pay above the HIPAA per diem, or the HIPAA cap, if you're familiar with that. It is an amount that the IRS allows from qualified long-term care solutions tax-free. As of 2017, it is $10,800 a month. But Nationwide will pay above that HIPAA cap. If we have a concierge level policy that has a pretty generous benefit, we'll pay the full benefit, even if it's above that $10,800 a month. Now that $10,800, it is indexed for inflation, so that limit increases every year. So there's a potential when you go to file claim, it will be below that HIPAA per diem. Now if someone does have qualified expenses that are higher than the HIPAA per diem, then their benefit is still tax-free. Their risk is taking a benefit that's over the HIPAA per diem if they don't have qualified expenses to meet it. And in that case, they may have some income tax on the amount that's above that HIPAA per diem or above their qualified expenses. So that is important to take note of. Some other things you don't often think about when it comes to elder care, there are a variety of other expenses that come up, right? Other healthcare expenses, hospital visits, medications, prescriptions, even transportation costs. There are some unique transportation that are necessary as people are incapacitated. Or if we're hiring a qualified caregiver or an informal caregiver and they have to drive maybe 30 minutes to a rural home, that 30 minutes of driving is often billable, right? But a reimbursement solution is not going to reimburse for transportation. Whereas you have a cash solution with Nationwide, you will certainly have that cash that you can use towards transportation costs. So there are a variety of unique things you can think of, extra expenses in this conversation that can be addressed with a cash solution. Now, Nationwide Care Matters is a brief infographic on how the product works and how its benefit will pay out. It'll give you a sense of pricing as well, how it's priced. So this example shows a 55-year-old female, non-tobacco, in a 6-year long-term care benefit. And it is a flat benefit, no inflation. So Nationwide has inflation options, but this one shows no inflation. And it shows a $100,000 investment. So to give you an idea of or a scenario where this might come to play, we have this 55-year-old female. Let's say she worked for state government her entire life. She has, at 55, early retirement. She's fully vested in the system, so she's got a great pension that's going to pay her generous income, and she has enough income from this pension to live on. At retirement, she also got a payout for maybe accrued time that wasn't used and any other bonuses, along with some of her savings. And so she has a pension to meet her income. She has health insurance met, and maybe she has $500,000 sitting in the bank from that accrued payout as well as her savings. Well, her risk really is that money she has sitting in the bank, right? If she has a long-term care need and she has to bring in a caregiver, an informal caregiver, and then at some point she has to pay for qualified caregiving, which once we start to pay for qualified caregiving, those costs can be quite high, right? And so her risk is she has income, and that income may be enough to maintain her lifestyle while she's receiving care, but it's not enough to pay for the caregiving itself. And so she's going to have to start to spend down that $500,000 she has sitting in the bank, right? That $100,000 she fully intended to pass down to her grandkids, right? And so her legacy is going to be eaten up by these long-term care costs. So let's take a portion of that legacy she intends to pass down, right? $100,000 invested in a Care Matters solution, and it immediately gives us a death benefit of $184.19. So she just about doubled her legacy on that $100,000, right, on that investment. So that's there. It's guaranteed no matter what happens. Now, if she does need long-term care, and she doesn't pass away before using long-term care, she has $541,257 of long-term care benefit. You see on the right-hand side here. That's paid out over 6 years, $75.17 a month for a total of $541,000. Now, if she lives to a point where she ages, she needs long-term care, she files a claim with Nationwide, we begin paying this income of $7,517. It reduces the death benefit dollar for dollar. So as she's receiving this monthly benefit, this 2-year benefit or this death benefit is being decreased. Once she has utilized $180,000 of death benefit, this death benefit is gone, and we continue to pay long-term care. So there's almost $361,000 remaining of long-term care benefits that she'll continue to receive until she's received $541,000. Let's say she received the entire $541,000 in long-term care and then passes away a little while later. Her family will still receive this residual death benefit of 20%. And this is ultimately what's guaranteed at a minimum in death benefit. And in this example, that's $36,000. So this is the attached final expense policy that I mentioned, and really where this is valuable and important and where it comes into play is for those cases or those individuals that have catastrophic long-term care needs. And when I say catastrophic, that generally is someone that needs care for 7 years or plus, 7 years plus, right? Someone that even if they have an insurance policy, if they need care, maybe it's Alzheimer's care in a facility, you know, more than likely they're going to use up all of their insurance policy, and then they'll start to use some of their assets. Maybe their family will use some of their assets. Their family will be left in debt. So when that individual passes away, having a benefit for final expenses becomes huge. And so that's really why Nationwide designed a stronger death benefit that's guaranteed on top of this long-term care benefit, so that those individuals that do have that catastrophic type claim still have a generous death benefit that will go a long way for the family at final expense time. So I mentioned this is a flat benefit. We do also offer riders, a 3% inflation rider. It's 3% simple inflation or 5% compound. Either of those riders will increase this monthly long-term care benefit over time. So as our 55-year-old individual right now purchases $75.17 a month guaranteed, with a inflation rider, there is a cost to it which reduces the initial benefit. So the initial benefit would be less when we add that rider. But over time, let's say over 30 years, by the time she gets to her age 85, this benefit will grow substantially. So whereas it's a smaller benefit to start, it might grow to $15,000 a month with our inflation rider by her age 85 versus $7,517 as a flat guaranteed benefit for life. So you really weigh with those inflation riders, especially for younger clients, you know, their family longevity when you think they might need the care. And, you know, if they've got great family history, there's a good chance they're going to live beyond 80, 85. That inflation really makes a lot of sense. They're not going to file a claim until their 80s, and they'll get a lot more benefit at that time. The risk, of course, is that maybe you have an accident and need care a few years down the road. Well, then you haven't had enough time for that inflation to really kick in, and so you'd have a smaller benefit. So that's something you really weigh, but for younger individuals especially, adding inflation protection really makes a lot of sense. One other thing I'll mention is that the product does have return of premium. So I mentioned that there's really no way the client can lose. There's no scenario in which the client can lose, but they're guaranteed in every scenario to at least get back what they invested. And so for this client, even if they cancel the contract, we offer 100% return of premium. Now it is on a 5-year vested schedule, so you do have to hold the insurance policy for at least 5 years. But you hold it for 5 years, you cancel it, you can get your $100,000 back. That vested schedule, it is a day one, it's an 85% return of premium, and that increases by 3% each year. So after 5 years, you have full return of premium. And so once you've met that vesting schedule, Whether you cancel the contract, whether you die and get death benefit, or claim it for long-term care, you're always going to get far more than you invested. Now, to give you an example, and this example really highlights what's possible with an indemnity or a cash solution over some of the traditional or reimbursement solutions that are in the market today. And you see up in the upper left-hand corner, one of the statistics, 70% of claims are home health care. And this comes out of some of the research done by Genworth. If you're familiar with Genworth, they monitor the market and do a cost of care survey every year. That's fantastic. It's really well done. It looks at, what care is costing across different types of care, as well as how long care is lasting. And so we see that 70% of claims are from home health care, but also that claims generally last for about 4 years. The average claim time is about 4 years. And if we're looking at care at home, and in this scenario we're using a $3,000 monthly average cost. You see that in the middle column here. Now this scenario, what we understand is that, and this is something that I've mentioned a little bit about, that claims are progressive, right? That they don't start out day one at $3,000 a month, but they are progressive. Your first year of care is going to be provided informally by family members when we're talking about the average individual, right? Maybe the first year, first 2 years are provided informally. And then as that care becomes a little more difficult, we're going to hire someone to come to the house, maybe for an hour or two each morning to help that individual get together for the day, right? And then over time, that care need progresses to where we're inviting folks over the house maybe 3 times a week, maybe 3 or 4 hours a day, to the point where we look at some sort of facility, whether it's assisted living or a nursing home, right? And so the care cost might begin at $500,000 a month, right? And then at the end of a claim, might end up at $5,000–6,000 a month, right? But over that period of time, we'll say in this example, it was an average of $3,000 monthly for 4 years. And as I've been talking about a cash indemnity solution, you can probably imagine that a cash solution is more expensive than the traditional reimbursement solution, right? Well, absolutely. Absolutely. We are guaranteeing you income in your claim to meet your long-term care need. A reimbursement solution is only going to pay out up to what your cost is. So in a reimbursement solution, that carrier, that company knows that for a good chunk of people, they're not going to pay out their entire benefit, right? Because they're not going to have costs that meet their entire benefit. And so this example really highlights that. In our average $3,000 claim, a reimbursement solution that offers $6,000 a month in benefit is going to pay out that average of $3,000 a month, and over our 4-year claim pays out $144,000. On the right-hand side, our cash solution offers $5,000 a month. So it's $1,000 less, but that $5,000 is guaranteed. No matter what our cost is, it pays out $5,000 a month, and over that 4-year claim pays out $225,000. Now you'll see there in parentheses with the first 3 months, $0. Nationwide does have a 90-day elimination period, and it is 90 calendar days. And so when you file a claim, 3 months from filing the claim, those income payments begin. And so there is a 3-month or 90-day elimination before those payments begin. So even that taken into account, Nationwide would pay out in this example $225,000. So I mentioned that the care scenario is progressive, right? Let's take the same example and say that this person did not pass away right after that 4-year claim, right? But maybe they did have to go to a nursing home. So our first 4 years of claim had an average cost of $3,000, but then we had to go to a nursing home for a year. We needed custodial round-the-clock care. And that nursing home cost $8,000 a month, right? We want a semi-private room in a nursing home, $8,000 a month. On the left-hand side, in the same example, our reimbursement solution, as we said, was paying $6,000 or could pay up to $6,000. So we have a $8,000 nursing home. Well, we have a shortfall of $2,000 while we're in that nursing home, right? Even though it pays out to $6,000, up to $6,000, we didn't use our full benefit in the early years of the policy, we can still only get up to our maximum. And so for that year in the nursing home, we're out of pocket $2,000 a month or $24,000. On the right-hand side, our cash solution pays up to $5,000, continues to pay that $5,000 a month in income. We have a shortfall of $3,000 a month or $36,000 from this cash solution, right? But thankfully, we were able to bank the early years of that benefit in our own pocket. It didn't stay inside the policy. So we have $81,000 that we've set aside in our personal bank account. That's more than enough to cover the $36,000 shortfall, right? For not just a year, but for 2 years. And even then still have a little bit left over. So there is a huge opportunity when we can get to our max benefit early when our costs are low. We can sock them away in our personal account and have the benefit of being able to pass it away to our heirs or cover additional costs down the road when they exceed what our monthly benefit is. And so that really gives the flexibility to cover any scenario. In visual form, to kind of highlight how this works, you see on the left-hand side, we have a cash solution, which offers less of a benefit with Nationwide than your traditional reimbursement solution. And at the bottom, we have cost of qualified care. And as I mentioned, our care is progressive in nature, so you see this curve over the years of care that moves to the right, moves up to the right. Well, a reimbursement solution, it follows the cost of that curve, right? You can see that reimbursement solution is going to follow your qualified cost until it meets its max, whereas the cash solution is going to pay guaranteed income over the life of the claim. Well, as the average claim goes, you know, in this infographic here, or this illustration, in those early years of the claim, about the first 3.5, 4 years of the claim, we're able to sock away this giant bucket of money and put in our personal pocket while our costs are lower. Right now, we may get to the point where you know, our costs exceed what our cash benefit's paying us, where a reimbursement solution might have reimbursed us more on the back end, right? But if we have all this extra cash that we've gotten in the early years of the policy, we can use that extra cost to cover any unknown costs at the end of our claim. You know, at the end of life, where a lot of those costs get to be a lot higher, when there are a lot of medical costs, right? Having that cash sitting in our personal pocket really gives us the power to use it however we need. To give you another example, and this is a case study of a reimbursement and cash solution with Nationwide. The reimbursement solution offered a lifetime benefit. And this was a gentleman that was looking for a generous benefit. He was a doctor. He wanted $7,500 a month for life. And with Nationwide, we don't have a lifetime benefit. We have a duration of 6, actually up to 7 years. But I said, hey, you're looking for $7,500 for life, and you found that with a reimbursement solution for $154,692 was the single premium. What could you get with Nationwide for that same premium? With Nationwide, you can get a 6-year benefit that would pay a max monthly amount of $8,568. And so in this example, you're really weighing $7,500 for life or $8,568, or $1,000 or more a month more for 6 years. And so if you think about the scope of lifetime, it sounds like a great deal, right? $7,500 a month for life. That is the better deal, isn't it? Well, let's take a look at some of the stats on claims, right? And these also come out of the ALTCI source book, as well as that Genworth Cost of Care survey I mentioned earlier. That 70% of claims are from home health care, where costs are less, right? Especially in those early years of the claim. 85% of claims last less than 5 years. Or put another way, 15% of claims are longer than 5 years, right? Beyond that, less than 5% of claims are longer than 7 years. So to give you that perspective, you see the third bullet point there that in 2015, national average cost for home health care was about $45,760, which breaks down to roughly $3,800 a month. So with those stats in mind, let's assume a little bit more than $3,800 a month. Let's assume $5,000 a month in average home health care costs. So that means, at the beginning of our claim, maybe our cost is about $2,000 a month. At the end of the claim, it might be about $8,000 a month, right, as we move towards more and more custodial care. But over the life of the claim, it's an average cost of $5,000. Well, how would these solutions pay out? You see on the left, the reimbursement solution pays out that average of $5,000 a month for that 6-year claim at $360,000. The cash solution pays the entire benefit, the full benefit as income for 6 years at about $617,000 roughly. So over that 6-year period, this cash or indemnity solution pays you an extra $257,000. Now, what is the concern here? Well, here's the opportunity. This first opportunity is more benefit for our heirs, right? We have in excess of $257,000 we've pulled out of the policy that's sitting in our personal account. Nationwide also pays a residual death benefit of $40,000. That's that 20% final expense policy I mentioned. So if this individual passes away after 6 years, the family would walk away with an extra $297,000 almost that they wouldn't have received with a reimbursement policy. So that's the opportunity. But what is the risk? The risk is that we are one of those individuals, one of those 15% that have a longer claim, right? Well, we've pulled out $257,000 in our policy. It's sitting in our personal bank account. Can we extend our claim? Absolutely. We can use the money from our pocket to continue to pay, on average, $5,000 a month for another 4 years. And so looking at an average $5,000 monthly cost, we can use our own money to turn this into a 10-year claim from Nationwide. And so you really have the opportunity to help folks win in either scenario. And in this case study, we could create a 10-year benefit or almost $300,000 of cash that the family gets to walk away with should the person die within the average claim time, right, which is really fantastic options. And if you look at stats on how many claims last longer than 10 years, it's less than 1%. And so you can use the cash to really cover a majority of scenarios and help clients walk away with more money or help them create a bigger legacy. So I want to leave some time for questions, but I'm going to walk through a couple additional opportunities with this product that hopefully will expand and give you some ideas on who this is good for and what clients might really benefit from a solution like this. More than those clients that are already looking for long-term care solutions, right, that are already aware of the long-term care need and looking for this type of solution. Looking at 2015 sales, this is an ideal for some alternative income planning. When you look at the traditional long-term care market, 2015 was about $261 million. The life and long-term care combo products or hybrid products, which this is, that market was about $3.1 billion. Now you look at the annuity market, $237 billion. So we understand that in the insurance market, far more people are using annuities as income solutions in retirement than any other sort of solution when it comes to long-term care planning. Now, there are legitimate reasons to use an annuity for income, for retirement income, absolutely. But when you look at stats on annuities and how often they're annuitized for guaranteed income, I think it's less than 5% of annuities are ever annuitized for guaranteed income, right? But that's the reason that annuities are sold, that they are vehicles to create guaranteed income, right? And so they're not always being used for guaranteed income, right? What we often look at annuities for is a safe place to stock our money, to set it aside, to invest it, that has relatively low risk, right, that we're not going to lose money. They'll have moderate gains, And after a period of time, we can access it for an emergency, right? We can draw down on it as needed. We can use it for healthcare costs down the road. What are our two biggest retirement concerns, right? The first is that we run out of retirement income. That's clients or consumers' number one concern. The second is healthcare costs in retirement, that blows up their retirement plan, right? And so an annuity is often used to meet those needs. Hey, let's set some money aside. It'll grow. If your traditional retirement income sources run out, you have this annuity to draw down on, or it's also there to use towards healthcare costs. Well, wrapped up in healthcare costs is also long-term care planning, right? If you need to pay for care, you can draw down on this annuity. Well, is that always the best solution? Let's take a look at a comparison. This is a hypothetical nationwide blanket annuity. It's bare bones, it's limited cost. I used a variable annuity at 6% just to generate a pretty decent return for comparison's sake. We have a 55-year-old that's investing $200,000 in this annuity. After 20 years at a 6% rate of return, this annuity grows. You can see circled there at about $527,000. So after 20 years, it grows to about $527,000. It takes nearly 40 years for it to grow to $1 million. And by 40 years, our client is well into their 90s. If you look at annuity solutions, and Nationwide doesn't have one, but there are annuity solutions that have long-term care riders, right? That they have a benefit pool that will pay out for long-term care, for qualified long-term care. They generally offer a 2 or 3 time multiple. So let's say this is a client that's pretty preferred health. They're pretty healthy, and they get a 3 time multiple in annuity solution. So their $200,000 gives them $600,000 that they can use for qualified long-term care. Well, even with that, those annuity solutions will pay that benefit, that long-term care benefit, only as a reimbursement for qualified loss. So very much like other reimbursement solutions in the market that we discussed. And so why buy, if really one of our reasons for buying the annuity is to cover healthcare costs and long-term care costs, why buy a solution that doesn't give us as much leverage, or when it does pay us for long-term care, pays us like an insurance policy? It reimburses our loss. Why not buy a solution that pays income, right? With Nationwide, if this is an individual that really is concerned about those healthcare costs and long-term care costs, instead of that annuity, we put $200,000 in Care Matters. It's immediately going to give us $1 million of total LTC, far more about what it would take at 6% rate of return, variable rate of return, not guaranteed in the annuity. It would take it 40 years to grow, whereas we immediately leverage it in this solution. Not only is it $1 million guaranteed, but it pays out as income when we file our claim. On top of that, Nationwide offers the 20% guaranteed death benefit of $72,000. And so this is for those individuals that are looking for a solution to meet those healthcare and long-term care costs down the road. This might be a much better solution to meet that need. And so as we're having conversations with clients that might only look at annuity or looking at investments, right, to meet that need, to grow their money, there's an opportunity to have this conversation. And not only is there far better leverage in these sort of solutions, this solution with Nationwide offers simplified underwriting. So I'll touch on that briefly. But unlike your life insurance solution that takes a lot of time to get underwritten, it's an exhaustive process. This is a simplified process with Nationwide, so we make it much easier to get through the underwriting. Another quick idea for you, I mentioned in a lot of the examples we use a 6-year benefit. That is what's commonly used. We know that the average claim is about 4 years, but we often over-plan or over-prepare for what our need is, right? And so we look at a 6-year benefit, which is most common. You can use as little as a 2-year benefit, and a 2-year benefit is less expensive. Now, when you add riders to the policy, those riders have varying costs, right, at different benefit durations, but it's the least costly at a 2-year benefit. And so you can design a product with a 2-year benefit and a 5% compound and it's fairly inexpensive. And this is an idea called long-term care wealth transfer from our pocket to yours when it comes to the long-term care planning conversation. And it really expands your view on what's possible with these sort of solutions. And so this idea is a 50-year-old male. He's got great income. He can afford to pay $20,000 a year to invest $20,000 a year out of his pocket. Maybe he's fully funded his IRA and his 401k, and he's looking for a place to invest some money. We can put $20,000 a year for 10 years into this solution at 5% compound. Now, the initial benefit is just shy of $272,000. So over 10 years, we'll be investing $200,000, initial benefit of $272,000 for death benefit and for long-term care. The way our 2-year benefit is designed, the death benefit and long-term care amount initially are the same. But with our rider, that 5% compound rider, that will grow. So after 35 years, by this individual's age 85, that benefit has grown to about $1.5 million. You see on the right-hand side here, it's about $1.46 million. Roughly $60,000 a month would be paid out over 2 years. So this is a fantastic way when we don't know how long our claim is going to be. The average claim is 4 years, but there are plenty of people that want to claim for a year, for 2 years, and so we really don't know how long our claim is going to be. When we can use a shorter duration with inflation, we can get a big benefit in a short amount of time and then manage our care from our own pocket. And so this is kind of a unique idea, more centered on those individuals that like to think of in terms of investment and on return and how quickly they can get a return. This example is about a 6.5% guaranteed internal rate of return at his age 85 in this example. So to kind of give you a sense of what's possible from this sort of solution. Really what's unique about it is if we think about the HIPAA per diem, which controls how much of it is tax-free. I mentioned earlier in the call that is $10,800 this year, but it's indexed for inflation, so that amount grows every year. In 35 years, that HIPAA per diem amount might be $30,000. And so we have $30,000 that the IRS would allow us to get from this policy tax-free. Using that assumption, if our benefit is $60,000 a month, we have a 50% of this income, this tax base, is tax-free. Which if you compare that to any other investment, right? If you invested $200,000 and it grew to about $1.5 million, you have $1.3 million of that that's gain, right? So if you compare that to any other investment, this is going to have a 50% of it is tax-free if we assume the HIPAA per diem grows to that point, which is quite possible, right? And so we can get great income or great wealth to pass down to our heirs to use to manage our long-term care out of our pocket, and it's got a great tax base to go along with it. So that's an interesting idea, and one that we're actually seeing a lot more sales from as a company. Now to talk about underwriting just briefly, I said it's simplified underwriting. It is a 3-step process: an application process, underwriting, which is a phone call, and then policy delivery. We can handle the entire process from start to finish in less than a week, but it generally does take 2 weeks plus from application to policy delivery. The application, you submit it to Nationwide, and then Nationwide does a insurance database check and a prescription drug check on the client. We then call the client and schedule a telephone interview. That telephone interview generally lasts anywhere from 40 minutes to a little over an hour, depending on the client's medical history. But we do all the underwriting via the phone. There's no fluid samples needed. We don't do any sort of paramed or blood or urine. We don't request medical records. We handle all of the underwriting via a questionnaire with the client over the phone. Once that phone interview is complete, we approve or decline the client. I can tell you that we average a little over 80% of an approval rate. For all applicants through this telephone interview, we approve about 80% of applicants. From there, we send out a policy that you can deliver to the client and pay the premium. And so we've seen these underwritten in as little as 3 days. But generally, it takes some time for the client to find, 45 minutes to an hour in their schedule to have a phone call. And so when we reach out to the client to schedule the interview, maybe in a couple of days, it may be a week out that they can do the interview. So depending on how quickly we can do the phone call with the client, that determines how quickly this is underwritten. All right, so we have just a little bit of time. I do want to open it up for questions.
And
Kristen
I already
Michelle.
have a couple. I have a couple for you already. On the 10 paid premiums, are they qualified HSA expenses?
Good question. Yeah, it is not qualified to use from an HSA because an HSA benefit is tax-free, and then you would turn that around and get a tax-free long-term care benefit. You'd create a situation where taxes are never paid on that dollar. And so, unfortunately, you can't use the HSA dollars.
And another question is what are the triggers for claims?
Good question. The triggers for claims are HIPAA compliant. And so if you're familiar with that HIPAA regulation, it is very much the same with most long-term care contracts. A client is deemed to, and deemed by their primary physician or their personal doctor, to not be able to do 2 out of 6 activities of daily living. Those things like feeding yourself, dressing yourself, bathing yourself, and their primary physician deems that, or cognitive impairment. So the physician says they have dementia or Alzheimer's. So that cognitive impairment triggers it as well. So one of those and what we call plan of care. That's also part of the HIPAA requirement. A plan of care from their primary physician with Nationwide, because it is a cash benefit, it doesn't have to be a detailed plan of care involving qualified caregivers. The physician can simply say, at this time, the plan is to have family members provide care or informal caregivers, and that's enough for Nationwide to approve the claim. So we make it as easy as possible.
I think that's our only questions, but personally, the applications that I have seen come in, once that phone interview happens, we literally have a decision in 2 days. I mean, it's quick. So, once you get through the application submission and the underwriting, I've seen them done in a week. So I think that's pretty impressive, especially when other companies, your underwriting process could go on for months because we're waiting for medical records. So that's just food for thought there. But I found this very eye-opening to the billions of dollars that are out there that we spend on the informal caregiving. So, but I wanted to thank you, John, for, as usual, doing a great job explaining. And if anybody has any questions, please don't hesitate to give me a call. And if I don't know the answer, I will find it out.
Well, thank you, Christy. I really appreciate everybody for joining me on the call, and Christy for you hosting me. Christy and Premier have been great partners of Nationwide, and so really appreciate it. You're in fantastic hands with Christy.
Oh, thank you. So, well, everybody take care, and I hope to speak to everyone soon.
Thank you. Goodbye.
Bye, John.